And joining us now with his take on the economy, we're always pleased to welcome back Steve Forbes, of course, chairman and editor-in-chief of Forbes Media. Steve has a new book out now. It's called Money: How the Destruction of the Dollar Threatens the Global Economy and What We Can Do About It. What do you think about the economy right now as we go to the second half? I mean, the stock market, if we're to see as a discounting mechanism, seems to foretell good things down the road.
Well, I think the stock market is looking even beyond the second half and into next year after the November elections, which looks like the Republicans are going to do very well, which means anti-growth initiatives from Washington are going to be fewer and fewer, and perhaps some of the current ones will be mitigated a little bit. Markets like to anticipate the future. So in a sense, we're like a baseball player. We hit about 180 in the first half of the year, get it up to 250, 260. Not great. Not going to get us World Series, but better than the first half.
Get your multi-million-dollar contract, though.
To some specifics, I mean, you heard Steve Leisman's report and talking about business investment is expected to pick up, hiring is expected to pick up. Is that how you see it? How encouraged are you?
I think there will be. Bank lending is picking up a little bit. For 5 years, the regulators have been pounding on banks about risk, which means don't lend to small and new businesses. That's beginning to ease up. The energy boom is still going along. And the tapering is hugely bullish. Contrary to what most people think, QE actually was contracting the economy. It was great for Washington, deficit without tears, great for big companies. They could borrow at no cost at all. But for small and new businesses, very tough environment. So what the Fed do when they tapers means there's more money for the rest of the economy, which is good.
Janet Yellen says she's not worried about inflation, and in fact, she wants a higher inflation rate. I can imagine you don't agree with that right now.
It's an absurd theory, and I think future generations are going to wonder what was going through these people's minds. I wish somebody in Congress would ask her why 2%, 3% inflation means $1,000 extra cost for a typical American family. So somebody should ask her, why is a family having to pay an extra $1,000 a year for fuel and food good for the economy? Why do they have to spend more? Why is that stimulating for the economy, spending more for same goods and services? It's a bizarre theory, but it seems to have a vice-like grip on these people.
Well, where do you see inflation right now, though? Do you think
inflation, because they don't know what they're doing with the dollar. Inflation is a real threat. The gold has picked up a little bit, not a good sign. So you have to watch out. The problem is the Fed operates by whim. And when you have that, you're like doctors who don't know what they're doing. You know,
so I take it that
you're
in the camp saying it's time to raise interest rates. You know, I'm sure you've been hearing all the sound bites and the headlines from Fed policymakers every day. Another one is saying the economy is back to normal. Time to start raising interest rates. You know, what do you think?
Well, it's like rent control on the housing market, and you end up distorting the market. So I think the sooner they gradually allow real rates to come again, it'll actually mean more credit for the private sector, because then banks will know what credit is costing, what they can lend it at, and have a margin. New players can come into the game if regulators pound the banks too hard. So the better, the quicker they lower those, allow those interest rate controls to come off, the better for the economy.
Your book is called How the Destruction of the Dollar Threatens the Global Economy and What We Can Do About It. What can we do about it right now?
Ultimately, go back at least short term to the kind of stability we had under the Reagan administration and Clinton administration. And ultimately, we're going to go to something that sounds very, very bizarre today, but it's going to come in the next generation. We're going to go to a gold standard again.
You think we could go back to the gold standard?
Absolutely. We had it for the first 180 years of this country's existence. And if we'd maintained growth rates that we had under the gold standard in the last 40 years, we'd have an economy today that would be 50% larger.
I know, but a lot of people, you know, would say that, you know, that we won't have a currency that is vast enough, dealing that the financial markets and central banks have gotten so big. And that also it's not because of gold. It's because of globalization. It's because of more technology that things have changed, not because of the gold standard. What do you say to that?
The classical gold standard, we had the biggest push for globalization in human history. As a matter of fact, 100th year of the beginning of the Great War, the First World War, it wasn't until the 1990s that we got the capital flows and the trade, global international trade, proportionate levels that we had in 1914 weren't reached again until the 1990s. So a gold standard, by making it easier to have cross-border capital flows, investment, and the like, because you actually know what you're going to get back in terms of a dollar instead of a 20-cent dollar, an 80-cent dollar, enhances globalization. It's like having 60 minutes in an hour. Imagine if they floated the clock, 60 minutes one day, 48 the next. Life would be very confusing. Stability is good. Money is a measure of value. That's the key thing, a measure of value. When you start to muck around with it, get the kind of sluggish growth we've had in recent
We
years.
can always count on you giving us something to think about. Thank you
We
so
know
much.
exactly
You're
where
very,
you- where
very
you stand.
diplomatic. I like that.
His new book is called Money, very simply. Steve Forbes joining us today. Always good to see you, Steve. Thanks.
Thank you.